Hi investors, Nick Garner here. Today I'm going to go through a bunch of economic data as applied to house price increases or decreases, because what I and lots of other people want to know is where's the market going to go? And it's not always as expected. And as you'll see from history, market crashes tend to come out from nowhere. So if the prevailing view is that it's high interest rates and high inflation, therefore prices have to decline, that's not necessarily the case. And I'm going to show you some charts and some examples from decades past where quite the opposite to a lot of the current view has happened. Anyway, let's get into it. All right, now the very first thing is I've assembled a large number of charts from Trading Economics, who I really like, and you can go and have a play around there too, pick out some metrics you think are interesting. I've chosen the house price index year on year as my core metric. And the reason for that is because it gives us a really clear idea of how markets fluctuate on over a given period of time. It kind of exaggerates things. And if I go back here, you can see this is the long run house price index, and here's the fluctuating chart. And you can see here we've had the property crash, the 2008 crash that I'm sure you know about. And then here you can see the same crash played out, but year on year change. And broadly, it's helpful to use this to really see where there have been amplified, or to see in really clear terms where the changes are, as opposed to looking at this, which is almost like a straight line, doesn't really mean a lot. Whereas we look at this, we can actually start to make some sense of where there have been big events and what other things correlate with them. Now, the thing about the property crash is a lot of people went or would say to me when I ask the usual question, how much do you think the markets dropped in the crash? And they would say 25, 30%, something like that. Well, nationally, that was the case. It was about 20%. But when you localize, and this is the system we use for that I helped build and did all the data for, this gives us an idea of how the markets behaved over time. So this is capital growth data. It's quite localized data as well. So this is for 5,000 to 7,000 houses. And you can see here that in the period from 2007 to 9, the market rose 14%, which is a bit weird. Now here it dropped 11%, and here it dropped 15%, here 2%. So the point about this is that capital gain varies massively from one region to another and from one area to another in an urban place or wherever. So therefore, if you buy in the right kind of places, i.e. cities that have good long-term economic prospects, that have good population growth and the right kind of population growth, i.e. people who are migrating to the area perhaps, and they're good at creating wealth, that's the right kind of population. The wrong population is just population growth, but they're not economically productive. So it's all good population growth, whichever way you look at it, because it's great that people are here and we need more people. But what I'm saying is if you want to target areas with a lot of capital gain, you look for those areas where the right people, i.e. people who can create wealth and bid the prices up, you look for those areas where they want to live. And the more solid the area, within reason, the less likely you are to see serious capital decline in the event of a property crash. Now, the other thing I want to say about property crashes in general is that they tend to happen out of nowhere. So the one in the 80s, the early 90s, for example, this one here, which kicked off in 1990, that was due to a government decision on pulling out of an interest rate mechanism, I think it was called. But essentially, the government just said, right, we're hiking interest rates now. And then suddenly the market crashed. In 2008, they just simply said, we're killing off borrowings because this has happened, i.e., subprime mortgage crisis. And then suddenly, market dead. So therefore, the lesson I take from this is that when the next crash comes, it'll come from nowhere. Because if people anticipate the crash, well, they just haven't been able to anticipate the crash. That's why crashes happen, actually. Now, here is a chart which shows the rent to price ratio, which is a very interesting metric. And by the way, I'm showing you a few slides and then I'm going to get into the predictive stuff. So the idea is we just get an overview of what's going on, and then I'll show you the charts that I think are the most helpful for predicting what's happening next in the market. But overall, what I'm seeing here is really the beginning of what I call unsustainably high rents. And you can see that preceding a crash, rents became unsustainably high. You can see it here back in the late 80s. You can see it here in the late 2000s preceding the crash. And you can see it here, obviously, building up. Now, the question is that going to top out up there? I suspect it might, because that would equal a long-term trend upwards. And it just kind of shows that that house prices are creeping up, and the ratio, i.e., the number of times and the yields basically are dropping, and that's what you would see here. And you can see in quiet parts of the market, the ratio was going down. So, for example, in the mid 90s. Interest rates were relatively high, property was relatively inexpensive. If I show you here, it was relatively inexpensive, and the market had gone sideways for a very long time, and therefore rents were relatively affordable. And then obviously you have its cycle. So I think this is worth watching, and it definitely tells me that the market is building up and becoming very pressurized. Now, what that means is it's a bit like an earthquake. When an earthquake happens, most of the time geologists can't predict with utter certainty that there will be there'll be an earthquake. They can say there are tremors, things are building up, be aware, but they're not going to say to you, right, you're going to have this mega earthquake at this time and day. And it's the same with predicting a property crash. We can see the pressure building up, but we don't know when the plug is going to be pulled. And even when there is a property crash, bear in mind, if one buys in the right kind of places and is sensible, i.e. good demographics, affordable, relatively speaking, and so on, then you will be insulated from the worst of the property crash. The thing that gets investors with property over is inflation. In other words, property goes sideways for 5 or 6 years, and inflation marches on, then the relative value, the value of property relative to wages declines. And then property becomes more affordable again, and then you have another surge in prices till it becomes less affordable, and then it starts all over again, which is why there are property cycles. And here we can see the mortgage rates, and it's circa 3.5–4%. This is the bank mortgage rate as a consumer lending mortgage rate, I think it is. And the main point to note here is that when mortgage rates are high, prices go down, which is obvious. But it's not always that correlated. So, for example, here, prices have gradually crept up, as in increases in house prices year on year, but rates have remained very static. And then we have decline in rates, and then rise in prices. Now we have decline or increase in prices. Now, in theory, what we should see, and what I do see, is a softening of the market. But a softening of the market isn't a crash. It's just simply a slowing down, which is okay in my view. And here we have just base interest rates and the same kind of correlations going on. The lower the interest rates, the more price increases we see. But in many ways, this is a more useful indicator because this is actually what people borrow, as far as I know. I think that's what BBA stands for or indicates. And here we have the base rate, obviously. Now, I mentioned earlier that markets tend to work in cycles, and here's a chart going back to 1845 from Schroders, the private bank, the investment bank, and it looks at average house price and average earnings, and it's the ratio of the two. So if average house prices are 13 times annual earnings, then houses are very, very expensive. And so they were, because a lot of people lived in dire poverty in hovels, and there you go. At its very least, the ratio was around 2, and that was after World War One. There was obviously a lot of casualties, a lot of quelling of demand, and also a massive amount of house building going on in Victorian times. So you saw a gradual decline of prices relative to wages, which was good. So people could afford decent homes. And then it kind of went sideways, and then up it went again. And each arrow represents a distinct property cycle. And here's an indistinct one in World War One. But you can see cycles, and they exist. And now we're cycle number 9, 10, if you want to include that one down there. Right. So then the next question is, what indicators should I use to track what might happen? And I've gone through maybe 100 combinations of charts and stuff and spent hours sifting through it. And this is the chart of truth, as it were, the one that I think really tells it all. Now, what I'll do is I'll go through this. I'll go through some of the other charts that are interesting, and then that'll be kind of that, and we'll do a recap. Anyway, why do I love this one? Well, this is the RICS Surveyors report, and it's a really simple one. It just measures the percentage of surveyors saying the prices are going up versus going down. So if it's 50-50, it's going to be sideways, and but it rarely is. And you can see here how the ratio declines and increases, moves all over the place. But very rarely is it kind of sideways. And that's kind of interesting in itself, because there's rarely a stable consensus, as it were. It's always oscillating. So then, why do I love it? Well, it's a predictor, that's why. And surveyors are obviously experts in what they do. They go to university for a long time. They become chartered. They look at hundreds, thousands of properties in their lifetime. Their judgment on valuations is incredibly important for the whole property system. So they make the judgment on whether a property is appropriately valued for a mortgage. They'll tell you if they make a judgment on its condition, or give you advice on condition. They will be expert witnesses in trials related to property disputes and so on. So the point is that they are effectively the judges of property in the property market, because somebody has to be that person. And what you see here from the red lines is that they are very good at predicting trouble. So here, way back in late 88, thereabouts, you can see that everything kind of got quite built up. And this is the thing that I'm looking for in the charts, by the way. It's a combination of a leading indicator like this and other indicators which say things are winding up or slowing down. And if all the indicators say that things are winding up and getting very tense, and we're getting near earthquake time, but we don't know when, then we need to be aware of that and then plan accordingly. Anyway, you can see how the relationship between their sentiment, surveyor's sentiment, and the market is incredibly correlated. And whenever they say it's going down, then they're basically ahead of time. So if they say, I'm not happy, I think it's going southwards, as it were, then you should take note, because you can see here, if the index is way down here, you can see that. Let me just go into the actual slide itself, because I think that might be helpful. And I'll just go full screen. I'll go zoom in. Let's zoom in. Yep. So I'll just show you this slide here. Sorry, I should have done all this in a more kind of fancy way, but hey, we're all friends, aren't we? So hopefully you don't mind. All right, so I'm just going to explain. By the time, if you think about it, when the surveyor says, you know what, this is looking bad, if you had paid attention, you would have avoided the crash, because already there was a seriously strong indicator saying don't, basically. The same here. If you look at this, they were starting to predict that the market was bad all the way down here. So, for example, here you can see that they were way ahead of the game. Now, this was in the 2000s. If we look closer to date, and we look at, say, 2008, they predicted it again. They knew. It's such a strong predictor. And again, here, they predicted the market would sink, and lo and behold, it subsequently did. And we can see that there. So I think this is an incredibly valuable predictor, and it seems to be pretty much a constant. Now, there's a big difference between an aggressively declining market. So, for example, this one here in 2008 is aggressively declining, but you can see that these are not excessive swings in sentiment. Here's an excessive swing in sentiment, but it didn't really affect the market because we had COVID and we had pandemic measures and fiscal stimulus and all of that stuff, which then cushioned the market overall. But you can also see here, massive swing up, and then more optimism, and now they're declining. So this is the metric I'm watching for. If this declines by, let's say, let's just go Control F5 so we can, oops, view, and yeah. If I see a significant drop in sentiment, say by 10 percentage points, so this is the index here, I think, and this one 0 to there because it's got a minus. If I see it shifting 10 points, then, sorry, it's this one. So the main index is here on the left. How do I know that? Because it's 40, yeah. So this is the main index here for the housing prices, and then this is the sentiment index here. And I would say that if it goes below 50, then I'm paying attention and I'm ready for crash alert. But we haven't reached that. And I don't think we will for a while, for at least another year, I suspect. Who knows? I don't know the future, but I do know that this is an incredibly good indicator to use. And as I mentioned earlier, it's in this Trading Economics website. Trading Economics, and you can get the indexes and you can follow it, or you can follow this on a number of different sites. So here's the investing.com one, and you can keep a track of it there. The nice thing about looking at long-term data is you can see long-term correlations, whereas the short-term data, there aren't any correlations to really look at. And therefore, it's pretty obvious that most of the time, the sentiment swings are predictive, and that's good. The only thing is that, again, as I've said before, you've got to look at other correlations and see what's going on there, and look at other relationships with other crashes and other swings. And then if you find a set of correlations, a basket of correlations, and they all say it's good or it's bad or whatever, then you've got some sense of prediction, as it were. Now, this is the UK inflation rate over time. And as you see, we've got the house price index on this side, and then we've got the inflation rate. And we can see the inflation rate's just ridiculous and has surpassed inflation from the mid-90s, which was a bad time. Or late 80s, should I say. The main point is that inflation generally negatively correlates with house prices. So in other words, inflation goes down, prices go up. Inflation down, prices up, etc. On the whole, I think just looking at the long run data, I would say, yeah, that's fine. That kind of works. But I'm not, in this case, this inflation is driven by COVID, and COVID is an exceptional event. It's supply side information, and it's also inflation, and it's also something we just haven't seen since the 1940s, and so that's why it's very important to look way back. And here we have inflation, and we have interest rates, and this touches on a big topic which I've talked about a few times, but in short, it's very similar to the 1940s, and there's a lot of reasons for that due to government debt and so on, which I'll talk about in a minute. But I'm kind of saying at the moment, I don't think this high inflation is necessarily a reason to be too scared about house prices. I think it is, I don't think it's such an issue. And there are reasons for that, which I'm going to talk about. And here we have more inflation. So again, supply side issues, as opposed to the 70s inflation, which was just competition for everything, because you had a large cohort of people who were buying at that point. And these would be the baby boomers, as they're called, who are the part of the population that grew, that emerged after World War II. So in other words, after the war, loads of babies, and then they subsequently went on to really arguably trigger a massive bout of inflation in the 70s. Food inflation, again, same story. Inflation's generally negatively correlated, so prices generally slow down when inflation goes up, and vice versa. So based on historic precedents, you would say, yeah, well, it's a pretty reliable indicator that high inflation, low property prices, low property growth. However, as I've said, what I think is that, well, there's some other indicators. Let me show you them first, and we'll get into why I think inflation isn't necessarily the real problem. Now, consumer confidence also tracks house prices pretty precisely, not as precisely as the RCS one. I mean, that is just on a level all in its own, because it's so amazingly actionable. But this is useful anyway as a lagging indicator, just to give you an idea of what's going on. And broadly, what we see with consumer confidence is people being absolutely smashed with the economy. The question is, will prices tank as they have done when confidence declines. It's arguable that it could, and as I've been saying to clients repeatedly now, we're on crash alert, and I'll talk about a little bit of that in a minute and how we mitigate that and so on. But anyway, okay, so now we've got the house price index, and this is the small business sentiment, and it correlates fairly well, but it's like one step back from consumer confidence. And I think this is a better indicator. So, in favor of this, we have the markets not tanking quite yet. We in favor of the it's not going to crash yet thing. We have, and you know what? I'll finish this section, then we'll talk about what's in favor, what's against, and then we'll look at a few other things. So business sentiment and earnings growth. Now, this is quite interesting in that there's different ways of analyzing earnings growth. Wages are going up. That's something. And wages and house prices, they don't necessarily correlate tightly. But the way I would look at this is that if wages go up, people save for a period of time, and therefore they have money to employ paying for deposits and so on. So that's a theory. I don't know if it's an accurate one, but you can say because of fiscal stimulus and a lot of people actually keeping their jobs, that there was a lot of money, or has been a lot of money, sloshing around, and just a really destabilized market, and therefore prices have held up quite well for these reasons. Now, this is real average. Now, this is an interesting one because this adjusts for inflation, which is really helpful. And you can see that in real terms, wages are actually declining relative to inflation, but nominally they're going up. Now, that's quite an important point when looking at house prices, because house prices are, if you think of it as non-inflation adjusted, then house prices go up or down, and they generally keep in track with money supply, which we'll look at in a minute. And money supply directly drives the amount of inflation there is. The more money there is in the economy, the more inflation there is, put simply. And here it is. So this is M0 money supply. This is the money that you got in your pocket, basically, the money on your card, the money just sloshing around in the consumer economy. And you can see broadly that it keeps in line with house prices. So the more money, the bigger the more house price, the more house prices rise. However, there are blips in this, and these, and you have inflation cycles and so on. But broadly, money just kind of keeps chugging along up, and then we have pandemic period and lots of weirdness, and then we've got a big surge in house prices. There's a surge in money in the economy. So if the government restrict the amount of cash sloshing around in the economy through quantitative tightening, and they try and soak up money through higher interest rates, inflation, and so on. Well, they don't want inflation, but what they want to do is just soak up as much spare money as they can and get the money supply stable so that inflation doesn't run away with itself. Now, I'm not that knowledgeable on economics, but I understand that's roughly how the principle works. And you can see a fairly clear correlation here. House prices flying up because of increased money supply. And this stuff tells me that the whole system is under stress, just like an earthquake building up, and that worries me a bit. And here we have bankruptcies. Now, broadly, I would say it's a very strange time for any business because of pandemic, and therefore, what I'm more interested in is the long run trend of bankruptcy. And I would say that broadly speaking, based on this as a building trend, as it were, they're kind of going up. So the market is under stress, and bankruptcies have increased, not substantially, but they've started tickling up, as it were, post Brexit. And you'll expect a lot of companies going out of business as this economy re-engineers itself. Now, also on the theme of economy, let's have a look at the stock market. And here you can see there's not a great correlation between stock markets and house prices. There's a vague correlation, let's say. Here, for example, we had the pandemic crash, didn't change property prices very much. We had the 2008 crash, did change them a lot. And you can see the 2000 crash did make the market suffer a bit, but it wasn't that closely correlated to the property market. So I look at this and I think, well, if the market is suffering, then I pay some attention. And the markets are declining a little bit, but this is a chart from today. So it seems to be all right. It seems to be holding out okay. And therefore, okay. Now, another chart which is interesting is full-time employment. And you can see how after 2008, there was a huge contraction and a lot of unemployment. So you can see it's not a 0 to 100 chart, it's 18 million, I think it is. And then, so at this point, 2008, there was probably maybe 22 to, let's say, 1 million or 1.5 million people made unemployed after the financial crash. But employment has just crept up ever since. And this is my other point, that on one hand, you have various stresses building up. On the other hand, you've got employment, like there's work and their wages going up, there's work, and people can generally pay their bills, I expect. This is the unemployment rate. And as you see, unemployment is gradually decreasing. So good. Now, I'm always a bit skeptical about unemployment rates because I think, well, there'll be a lot of government massaging of data and metrics, whatever, but let's assume that is reasonable. The point is that we're not having a massive employment downturn. We had something going on here during pandemic, but and the other thing I want to say is with full-time employment, these are the mortgageable people, and in any given area, on average, 3% of properties are sold. 3 out of 100 properties are sold in an area on average each year. What does that mean? Well, it means that if there's a load of competition for those 3 out of 100 properties, and people bid those properties up in price, then in any given year, then that makes the market. That determines the average house price for the area. So it's a really important thing to understand. And therefore, you don't need that many people chasing property who have the means to bid the price up for the price to increase or decrease. It's an important point. And the other thing to remember is house prices are incredibly localized. And I'll show you some maps and stuff shortly, but we'll just get through the rest of this. Anyway, so the market from an employment rate is healthy. We can see it's very low. Now, the only issue is that if you have extremely low unemployment, then you are prone to wage inflation. And that's because there's just so many vacancies that employers are doing whatever they can to get them, and they'll offer higher wages to attract people, and thus it drives wage inflation, which is kind of a dangerous thing. Whoops. So it's very important to factor that in, as it were. And let's oops, where is this going? Sorry, it's all going a bit crazy. Let's go back to the slideshow. I was trying to be smart and getting the slideshow working, but it just wasn't doing it for me. Here we go. All right. So the unemployment rate, as you know, just zipping through this. Yeah, so the unemployment rate being so low means that we're likely to have uh, wage inflation, and wage inflation is a bad thing because it fuels inflation in general, and then if it gets out of control, we're all doomed, basically. Anyway, this one here is so unemployment is an interesting one, and if unemployment grew dramatically, then I'd be worried, but unemployment is low. And here we have lending to individuals all over the place here, pandemic times. But in general, you can see that lending is relatively low as compared um, to the 2008 period. So in other words, there's a lot less lending going on, which is probably a fairly healthy thing in a way, although it's oscillated massively here because of COVID. But broadly, seems to be okay. Now, this is mortgage approvals, and again, it's just bounced all over the place. And I expect it'll just find its level here, and then we're fine. And here we have the house price, long-term house price gain, just for reference. And this one I find quite interesting. Broadly, when prices decline, savings go up, roughly speaking. And here we have declining spaces and, oh, sorry, what was I saying? Declining savings. So I was distracted. Declining savings, and we have declining prices or declining changes in price. But as we know from here, it was just plateauing out for a while. Then there was a big surge. And here we have huge savings because of fiscal stimulus, and now it's probably going to plateau out, and it's already tanking. So that's interesting. And broadly, what I would say is that if savings are relatively low, then prices are more likely to increase, as you see, because that's the correlation. It's a kind of inverse correlation. And producer price change, this is industrial production changes in cost. And same rough story here, more or less an inversion. So in other words, when prices go up, generally speaking, as prices go up, markets go down. But we're not really seeing this correlation yet here. So I'm not sure if that's going to play out, and doesn't always correlate. You can see here, huge price increases in property, but pretty much not much going on with the PPI or UK producer prices. So here we have consumer credit. I think that's kind of interesting in that it broadly correlates, and we can see that consumer credit is bouncing around at quite a high level, and I expect it's going to go up as things become less affordable to people. Now, there are numerous other indicators, which I'm not going to go into. Mortgage approvals, yeah, I mean, it's a very tight one, and it's not quite a leading indicator, but actually it's one that I should have put in the first batch. It's quite a good one, actually. And one just has to watch that. So if mortgage approvals decline significantly, then it's a problem, and I want to pay attention to that. And then we have other metrics, loads of them. But the other ones are the ones that I like the best, because there's only so many charts you can fill your brain with, I suppose. And some of them are lagging or whatever. But whatever I've done, I've looked at charts, which I looked at all of them, in fact, and all of them on the Trading Economics site. And overall, the charts that I picked were the ones that seemed to be the best. Here's some of the tools we use day in, day out for analyzing the market. And the reason I'm showing you this is because broadly, as you know, there are various arguments for why the market might go up, why it might go down or sideways or whatever. And so from a macro point of view, we can take an overview and we can say, well, we think this. I think the market's probably going to go sideways, and then there'll be a crash because there are property cycles, and cycles are pretty predictive and they're pretty repetitive and so on. And beyond that, then there's a different thing about, well, okay, we know there's a crash. How do we deal with it? And the other is, well, should I invest right now or not? And in short, on that front, it's probably likely to have we're probably in for high inflation, low interest rates for quite a long time. And there's a whole strategy you can employ based on that, which I will talk about briefly at the end of this. Anyway, the other thing to remember about capital gain is that the markets are very localized. And here we have Manchester. I've got data for the whole country, but you can see that in a crash, some areas don't decline very much. This area declined 3% between peak of market in 2007 and 2009. So it's not that 4%, 7%, 11%, 8%. But some areas really did get hammered, and I'll show you a couple of patches which did very badly. Let's have a look. Liverpool, I think lots of areas in Liverpool were really trashed. This one declined 20. How much did it decline? This one dropped 21% and 20. What was it? 16%, and so on. So a lot depends on where you are. And then beyond that, then you've got another metric, which is how did the price relate to the 2007 market high, or how does the price relate to that? And so what I'm always looking for are areas that are either within 20% of the 2007 market high in real terms, i.e. inflation adjusted terms, or yeah, that's what I'm looking for. And I'm also interested in whether an area feels overbought or not. And from there, I can kind of work out, okay, how's this doing compared to then? So this area here, whatever area it is 34% above that in real terms. So the median house price was 80,000 back then. If you adjust for inflation, it should be 123,000 in today's money if you adjust for inflation, and now it's up to 147,000. So that's a busy place, and there's a lot going on here. And when things get relatively overbought, I get a bit concerned, and therefore I'm always cautious of these kind of places. So what I'm interested in is genuine affordability, or whether the area has just simply gone up in demographic terms. Now, here's an area, and I don't know if this might be Droylsden, Clayton, Droylsden. Yeah, this whole area has gone up massively, but patches have gone up more than others. Anyway, the point is, capital gain is very localized, and it's important to be able to evaluate one local area from another, and then you can kind of work it out from there. It's quite difficult if you don't have the right tools, I will say, and this is why we built this thing. And annoyingly, it's not publicly accessible because we don't have the tech to make that happen. But anyway, that's that. Now, finally, I just want to talk about strategy briefly. I'm not going to go into this in a huge amount of detail, but by the way, I forgot to say, this is housing supply, which I touched on with the rent versus house price chart. The rent as the rent, we'll go back to the start, the UK price rent ratio, and how it's gone right up here. It's gone right up, and it just signifies demand. And what you see here is housing supply from 2008, and it's just tanked, and then it's kind of leveled out. and gradually, well, it's just leveled out, it's gone flat. So it's gone from negligible supply, and this is 0 to 700,000, and you can see literally half the market was just wiped out actually. So in say this area here, which was for terraced houses in northwest England, for example, but this is an overall indicator for this. This is different types of property for northwest England. I have one here for. I have a chart which is overall sales, and you can see it's not quite as catastrophic, but it's not far off, where literally supply just tanked. And it never really recovered to pre-2008 levels. But you can see long run supply isn't looking great overall. And that's driving demand, because there are some people who have got jobs, who are increasing their wages, who are doing okay. Those 3%, those people are chasing those 3% of properties. And if you think about it, it's half the number of properties available per year versus pre-2008. So no wonder there's a housing crisis, and why prices are going up, because there's just so much competition for it. And even if the markets thin out a little bit, i.e. the indicators lead us to a lot more strain, I just think that we have something that trumps everything, which is we have high employment, wage increases, although inflation is doing that in, but high employment, and a group of people who can compete and drive prices up. So that's my core thesis on why I don't see a crash yet. And when a crash comes, it'll just kind of come out from nowhere. Now, back to the strategy point that I was talking about. So for a whole bunch of reasons, which I've explained in other videos, I think it's low inflation, low interest rates, high inflation, and that's due to government debt. I'll just do a 1 minute explainer. In the 40s, there was high inflation, low interest rates. 70s, high inflation, high interest rates. What was the difference? Government debt. And if the government raised interest rates too much, they raise the cost of managing their debt too much. Therefore, they have to get more taxation income. And therefore, if you imagine you have high inflation, i.e. high inflation, everything costs more. High interest rate, everything, cost of debt is higher. And then on top of that, you have higher taxes to pay for higher government debt cost. It's just an absolute mess. So what the UK government and the US government did back in the day was, when they had a lot of public debt, they just let inflation run high for a long time. And then the debt gradually eroded in value and then became more stable. And now it's crept up to 100%, but it's nowhere near what it was between the World War I and II. But as I say, history shows us that interest rates are likely to remain relatively low for the reasons I've mentioned. In that event, what do you do? Well, I'm not going to go into this in any real detail, but I'm just going to do a very brief highlight. I've done some calculations on this, and I'm going to do a full video where I totally nerd out on this stuff. But the short of it is that if you look at the previous property cycle, which I've done from 2005 to 21, and you look at essentially eroding the eroding value of money as a key idea. So if you buy a house for cash, that cash could have been employed to stay up with inflation, but instead it's sitting in a house, and the house has to go up in line with inflation in order for your cash to work hard for you. to keep up with inflation at least. So what happens is broadly your money over time gets made worth less and less because of inflation, but you have the benefit of your capital um, going down relative to rent and relative to purchasing power. So for example here, um, this is the predicted increase in, so house prices will increase, we assume, at a certain rate, and uh, and then because nominally they probably will, because inflation means just people have more money. But it depends what kind of inflation. As I say, I think it's 1940s inflation. And it's not just what I think, it's what a bunch of economists think. And therefore, if you have that, then the true value of your debt gets eroded by over a third, which is nice. So you make money because the value of the mortgage is declining relative to the value of the house. But also, if you look at it from a purchasing power point of view, then as inflation increases, wages increase, and therefore the value, the true value of this debt, this mortgage debt, decreases over time as well by nearly 50%, which is crazy. And you're not doing anything. You're just like owning the house, running a fixed rate interest deal, and getting your rent in and being a good landlord. And as you see, it erodes down to 54% of the original mortgage purchasing power. It's a lot of concepts to kind of get your head around, but the reason buy to let seems to be worth it is because generally rents will increase in line with inflation. If we have a 1940s scenario with low interest rates, then the cost of debt will remain low and the value of property will creep up, maybe not in line with inflation, maybe slightly below inflation, but inflation is high. But nominally, the value of that property will start to creep up, as I said, and then you end up, let's go and find our little chart here. Yeah, and nominally the price keeps creeping up, and then you do well. So therefore, it is a very good idea based on based on this hypothesis of low interest rate, high inflation, to get borrowings and put them in a property that's safe, in a good location, that's pretty crash resistant, has good demographics, and so on. And then in theory, that should be a very good long-term investment. Certainly, it's what I'm banking on personally. And therefore, so that's broadly it. Now, just to recap, taking it from the top, there's a lot to take in here. So there are a number of indicators saying that we're in for a crash. There are other indicators saying we're not. Broadly, I would say that the best indicator that I know of, the RICS one, is saying no crash yet. If sentiment declines from that metric, then I'm worried, but that hasn't happened yet. Property cycles tell us, historic cycles tell us there will be a crash, but we also know from the last two cycles that the crash kind of came out from nowhere. And that's typically how crashes work. They're what they call black swan events. There was a book by Nassim Taleb called Black Swan. It was all about that. It's essentially systems become so taut and tense and efficient that a small event can trigger a massive outcome. And so I don't know what that event will be. I'm not even going to try and guess. But what I can tell you is that just like pressure building up pre an earthquake, it's building up, and it's just a question of time. However, as you see, the property crash doesn't have to be a big problem if you buy in the right area. And And even then, when you factor in the probable high inflation, from a nominal point of view, i.e., the actual money value of the house, it's probably just going to be a blip, actually. Uh, and that's what I see. So essentially, in this country, I think we're all going to get poorer and poorer and poorer over a 10-year period, just like in the 40s, and it becomes this kind of massive rebalancing, I suppose you could say. And it's all to do with eroding debt, the value of debt. And the point is that if you are somebody who has debt and you're in these circumstances, then the value of that debt will erode as well, assuming fixed interest rates or low interest rates. So that's quite a lot to take in. I would say out of 10, my crashometer, crash within 1 month, 1. 10 is very high. Crash within 3 months, 2. Crash within 6 months, 3 probably. Crash within 1 year, I'm going to go 6 on the crashometer. If it's 1 year. Crash within 2 years, I would say 8. Um, and in respect to like how will it all turn out for an investor in the next 10 years, I think everyone's going to be poorer. I think it's going to be very difficult to find a safe investment that keeps up with inflation, so it becomes a capital preservation task. And based on my numbers that I've gone into, I think this buy to let stuff makes a lot of sense, actually, if you buy in the right area and do all that kind of stuff. All right. I hope that's helpful. Thank you very much. And until next time, good investing.